Imagine waking up to the news that millions of people are pulling money out of their bank accounts, not because the bank is failing, not because of panic, but because a digital dollar is offering a better deal. In a not-so-distant future, your money could sit inside a digital wallet, earning meaningful yield, while your traditional savings account pays pennies. This isn't science fiction. This is the looming reality of interest-paying stablecoins, and it has banks, regulators, and policymakers deeply concerned. Could crypto-based dollars quietly trigger a modern-day bank run, not through fear, but through logic? Today, we're breaking down the risks, the incentives, and the uncomfortable truth behind stablecoins paying interest, and why this debate strikes at the very foundation of the global financial system. Stablecoins are digital tokens designed to maintain a stable value, usually pegged 1-to-1 with the US dollar. They already function as digital cash instant settlement money, a bridge between traditional finance and crypto. Traditionally, stablecoins don't pay interest. They're used to park capital, move funds quickly, or settle trades. But here's the critical detail most people overlook. The reserves behind stablecoins already earn interest. Those reserves are often invested in short-term government debt, cash equivalents, or bank deposits. The interest exists. The only question is, who gets it? And once that interest flows to users instead of issuers, everything changes. Interest is magnetic. If a stablecoin begins paying even modest yield, 3, 4, or 5%, it stops being just digital cash. It becomes a digital savings alternative. At that point, the comparison becomes unavoidable. Why keep money in a bank earning almost nothing? When a stablecoin offers competitive yield, instant liquidity, and global access, we've already seen how powerful yield can be. In the past, extremely high returns attracted massive capital into crypto systems that claim stability, until confidence broke. Yield doesn't just attract money, it attracts fast money, and fast money leaves just as quickly. The collapse of Terra's stablecoin was a painful lesson. It offered exceptionally high returns while promising stability. Capital flooded in. Billions of dollars chased yield under the belief that the system was safe, but when confidence cracked, everything unraveled. Investors rushed to exit. Redemptions overwhelmed the system. Liquidity vanished. What followed wasn't just a crypto failure, it was a bank run, executed at internet speed. No branches, no lines, just mass withdrawals in real time. It showed how quickly confidence evaporates when yield and stability collide without safeguards. This risk isn't limited to experimental designs. Even fully backed stablecoins have experienced moments of extreme stress. When questions emerged around reserve exposure tied to a failing bank, confidence wavered. Billions exited in days, not because yield failed but because trust did. That's the key lesson. Stablecoins don't need to be flawed to experience runs, they only need uncertainty. Now imagine layering interest payments on top of that. Higher yield means larger balances, more sensitive capital, faster exits. A stablecoin paying interest becomes more attractive and more fragile. Banks survive on deposits. Deposits fund loans. Loans fuel economic growth. If deposits migrate into interest-bearing stablecoins, banks lose their cheapest and most stable source of funding. That forces banks to reduce lending, raise borrowing costs, seek expensive wholesale funding. The impact doesn't stop at banks. It reaches mortgages, small businesses, consumers, the broader economy. This is why banks are aggressively lobbying against stablecoin interest, not because stablecoins are unsafe, but because they work too well. Interest-paying stablecoins begin to resemble a parallel banking system. They take deposits, they invest reserves, they promise liquidity, but they operate without deposit insurance, central bank backstops, traditional banking oversight. This mirrors the shadow banking system that amplified financial instability in the past. Speed is the difference. Blockchain systems move capital instantly, confidence shifts instantly, and when money moves that fast, stress spreads faster. Regulators face a difficult choice: allow stablecoin interest, risk deposit flight, increase financial volatility, ban stablecoin interest, suppress innovation, push activity offshore. Some argue stablecoins should be regulated like banks. Others argue banning yield only delays the inevitable. There is no easy solution, only trade-offs. So will interest-paying stablecoins trigger a bank run? Not the kind with panic and chaos, but the kind driven by quiet decisions, repeated millions of times. A slow drain, until it isn't. Stablecoins paying interest represent more than a crypto feature. They challenge how money works, who controls it, and where trust truly lies. And the way regulators respond may define the next era of global finance. Because once people realize their money can work harder, instantly and digitally, the system doesn't collapse overnight. It evolves, or it breaks. If this helped, please like the video, subscribe to Express EconGeoFinance Insights, and share your thoughts in the comments. Thank you.